Hey everyone, Daniel here from Next Level Life, and today I'm going to be talking about index funds. Now, I've talked about index funds a fair few times on this channel, but I've never really gone in depth about them. And after getting a few questions about it, I figure it's high time that I actually go through some of the more popular ones and explain a little bit more about them in detail. So in this video, I'm going to be taking a look at the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. And I'm going to be explaining to you what those indexes are, as well as what type of stocks are in them. And I'll wrap it all up by going through the last 40 years of the stock market and show you just how well or poorly these indexes have done. Let's get started. So what is an index fund? An index fund is a type of mutual fund whose goal is to track the components of a market index, such as the S&P 500. Which means that when you invest in an index fund, you're not really investing in the S&P 500 that you see on TV. Which for most of us is great because that S&P 500 is currently valued at around $2,500 or so a share. That's probably a wee bit out of most of our price ranges. So when you buy an index fund, it's usually a lot cheaper, and it also has the same exact stocks that are in the actual index fund, whether it's the S&P 500, the Nasdaq, the Dow Jones, or whichever one it's tracking. So even though you're investing in an index fund, instead of say the actual S&P 500, you're still basically getting the same thing. One advantage to index investing over actively managed investing is that index funds usually have lower expense ratios, since the managers of an index fund are just trying to replicate what their benchmark index did. And as a result, they don't have to pay any research analysts to help select the stocks that they think will outperform the market. I covered this a lot more in depth in my passive investing versus active investing video, which, if you're interested, I'll leave a link to it in the description below, as well as in the card in the upper right hand corner of your screen. But as a result of these lower expenses, index funds usually have a head start over their actively managed counterparts. For example, if you had an expense ratio of 0.15%, like the Vanguard Total Stock Market Index Fund has, an actively managed fund with an expense ratio of about 1%, the actively managed fund would have to beat the index fund by more than 0.85% per year in order to come out ahead. And since statistically speaking, index funds typically outperform 80% of their actively managed counterparts, that head start becomes even more important. Though there are disadvantages as well, which, like I said, I covered in my video on active versus passive investing. But getting back on topic, index funds, like I said, are basically just trying to match a broad benchmark index. The most popular benchmarks, of course, are the S&P 500, the Dow Jones, and the Nasdaq. So what exactly are these benchmarks? What are they made up of? We'll start with the S&P 500. The S&P 500 is based off of market capitalization of 500 large US companies on the New York Stock Exchange, or the Nasdaq, and it is said to hold about 80% of the US stock market's value, which is why so many people consider it one of the best representations of the market as a whole. And while it wouldn't be technically accurate to say that it's just the 500 largest companies in America, as the committee that selects which stocks go into the S&P 500 and which ones don't also consider things like annual dollar value traded to float adjusted market capitalization, and the minimum monthly trading volume, among other things, saying that it's the 500 largest stocks in America would still give you a fairly decent idea of what's in the index. Because with the S&P 500's current weighting methodology, companies like Apple, Google, Microsoft, Johnson & Johnson, General Electric, Wells Fargo, those sort of companies comprise a fairly sizable chunk of the index's value. Now let's take a look at the Dow Jones Industrial Average. The Dow is a price-weighted average of 30 significant stocks that are traded on the New York Stock Exchange and the Nasdaq. It was designed to serve as a sort of proxy for the broader US economy, basically giving people something to look at to figure out whether the market went up or down on any given day. And when it first launched, it included just 12 companies, and almost all of them were industrial in nature. However, as I said, it's now up to 30 companies. And the other important thing to note about the Dow is that it's a price-weighted index. This means that stocks with higher share prices are given greater weight in determining the actual value of the index. Initially, when the Dow was just 12 companies, the value of the index was calculated by adding up the share prices of those 12 companies and dividing by 12. It was a simple arithmetic average. Today it's a little bit more complicated because, while you still do add up the stock prices of all the companies in the index, you no longer divide by how many companies there are in the index. There's something called a Dow divisor, which, as of September 1st, 2017, was something ugly like 0.145233968 and so on. That ugly little number is what you divide by now. Basically, what it comes out to mean is that every dollar change in a particular stock in the Dow equates to about a $6.89 change in the index itself. And just in case you're interested, here's a photo of all the companies that are currently in the Dow as of this recording. Next, let's take a look at the Nasdaq Composite. It's a market capitalization weighted index similar to that of the S&P 500, and it is calculated in a similar manner to the Dow by taking an aggregate value of each of the company's share weights, multiplying that by the price of the company in question, and then dividing by a divisor. Also, the Nasdaq's requirements for inclusion are a little bit less restrictive than the other two indexes. The Nasdaq actually holds nearly 3,000 stocks, with the majority of them being technological companies. And unlike most other market indexes, a company does have to be headquartered in the US to be eligible to be on the Nasdaq. In fact, to be eligible for inclusion in the Nasdaq, there's only a few requirements that you have to meet. First, you must be exclusively listed on the Nasdaq, unless of course your stock was already dually listed on another US stock market like the New York Stock Exchange prior to 2004, and has maintained that dual listing since then. And it also must fit one of the following security types that you see on your screen. So to wrap up this video, let's just have a little fun. Let's say that you invested $100 a month into one of these indexes for 40 years. Which one would come out ahead in the end? And for those of you that are curious, the time frame I'm going to be using will be from September of 1978 to September of 2017, because that's the most recent 40-year period that we have data on at the time of this recording. And just to keep things simple, I will not be including dividends in these calculations, I'll only be focusing on stock price appreciation. So, assuming that you started with nothing, and you invested solely in the S&P 500, you would have ended up with $381,355.38 by September of 2017. Now that's an average of an 8.6% rate of return per year. But if you invested solely in the Dow, you would have ended up with $402,656.99 by September of 2017. That's an average rate of return of about 8.8% per year. Both of them great. However, if you invested solely in the Nasdaq, you would have ended up with a whopping $782,476.03 by September of 2017. Now that's an average rate of return, without dividends, of about 11.2% per year. That is crazy. So based off of appreciation alone, the Nasdaq has done the best, at least over the past 40 years. But that's not to say that it's the only index worth investing in though. Again, I didn't consider dividends into those calculations at all, and most of the value of the Nasdaq comes from those big tech stocks that often historically haven't paid a ton of dividends if they've paid dividends at all, especially when they were growing. And honestly, 8.6%, 8.8%, 11.2%, I would happily take any of those averages over a 40-year period for my investments. But that'll about do it for me. I hope you enjoyed the video, and if you did, or if you learned something, be sure to like and subscribe. I've got a lot more of these finance videos coming out in the near future, as well as some more book summaries and maybe some other fun stuff down the line. And if you want to be notified whenever I post a new video, be sure to hit that bell next to my name. But with that being said, thanks for watching, and have a great day.